Now is a good time to discuss investing. With a lot happening in the financial market and investment buzzwords flying around due to market manipulation, stock prices volatility, and triggered buy and sell positions, you may be wondering if investing is risky or not. The reality is, investing can be risky, but the term risk depends on individual financial goals and objections. The most common risk associated with investing includes economic risk, political risk, and overall market risks. An average investor's worst fear is losing all their hard-earned money in investment opportunities gone wrong. This is a valid fear. However, we need to remember that with risks comes return. How risky an investment is comes down to different factors at play and what your risk tolerance is. Hi, my name is Kobe, an associate with Noor Private Wealth. If you're new to my channel, we focus on helping our clients build wealth in the most tax-efficient way. And in today's video, I'll discuss the factors that determine if investing is indeed risky and how best to manage an investment portfolio. So let's jump right in. What is the possibility of losing every dollar you've invested? Now, this question depends on how you have invested. If you invest in a single stock or a company, for example, and that company goes bankrupt, you stand a chance of losing all your money. This type of investment risk can be classified as unsystematic risk, basically a risk that can be diversified. To manage the risk of losing it all, you would be better off having a diversified portfolio of stocks across different companies, sectors, and asset classes. Investment diversification helps even out gains and losses in your investment portfolio while making expected returns. Owning a balanced portfolio of stocks and bonds in both domestic or foreign markets and across various organizations can be an effective approach to managing unsystematic risk. Now, a second factor that affects investment risk is market volatility. Market volatility and uncertainties in the economy pose some form of risk for investors. However, investing in financial markets can be profitable when executed with expertise. While there may be some fundamental backing to expectations in investment performance and returns, there is still the variability factor in returns. Volatility can be considered systematic risk, which cannot be diversified. Should you be worried? Well, that depends. If you're a short-term investor or frequent trader, then maybe. The volatile prices would definitely get your stress levels on the high side. A highly volatile investment can have you earning so much in capital gains in 1 second and losing significantly the next second. However, for long-term investors, this somehow evens out in the long run. If you do not make the mistake of overtrading and overreacting to temporary market swings, your investment can pay out in the end. I discuss more about it in my video, How to Invest and Actually Make Money. You'll find a link to it up here. Market volatility further leads to uncompensated and compensated risks. With compensated risk, you expect to make future returns from systematic risks that are accounted for in the stock's price. This is like compensation for investing in specific instruments. On the other hand, uncompensated risks do not offer additional return expectations. They are mostly faced by risk-loving investors. An example is putting a lot of money into a single company, stock, or a single sector. The outcome can go either way. Again, with diversification, you can effectively balance out the compensated and uncompensated risk in your portfolio. If you're extremely risk averse and skeptical of incurring losses, saving cash in a general savings account may be a safer option, but you could miss out on opportunities to earn higher returns, generate investment income, and build wealth. Alternatively, in order to avoid losses and manage market returns volatility, risk-averse investors can opt out for guaranteed products such as Guaranteed Investment Certificate, GICs, or invest in fixed return bonds. However, they would face the risk of inflation. Think of it as what your real returns would be many years from now. given the rise in prices of goods and commodities? Would your returns be enough to cover up for increased prices? The fact remains that financial markets are often cyclical and come with inherent risks. There is the risk of inflation eroding your real returns and market risk of volatility in prices and returns. However, in the long term, periods of boom make up for troughs and financial losses. Your investment objectives, risk tolerance, and personal status influence your investment decisions. Depending on your preferences, risk appetite, and returns expectations, you can invest through different investment options such as stocks, mutual funds, index funds, real estate, government bonds, and bills, among others. Remember, diversification is key, and so is adopting the right investment strategies. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more, don't forget to subscribe. If you have any questions or comments, please let us know below, and the senior investment advisor on the team will get in touch with you. Thank you very much for watching, and I will see you next time.